Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lanka's gross official reserves increased to $7.28 billion by the end of February, according to the latest data released by the Central Bank of Sri Lanka. This marks an increase from $6.8 billion recorded a month earlier and represents the highest reserve level in 6 years. The figure includes a currency swap facility of about $1.4 billion with the People's Bank of China. According to the data, the current reserve level provides approximately 4 to 5 months of import cover, indicating a significant recovery from the country's economic crisis period. However, the Central Bank of Sri Lanka's reserve template also indicates a short position of $3.9 billion in foreign exchange swaps and forward contracts, which analysts monitor as a potential future pressure on reserves. Foreign currency reserves amounted to $7.06 billion in February, up from $6.69 billion in the previous month. Gold holdings also increased to $200 million compared with $109 million recorded a month earlier. Meanwhile, reserves held with the International Monetary Fund remained unchanged at $4 million. Special drawing rights stood at $23 billion, declining from $32 million recorded in the previous month. The Central Bank of Sri Lanka estimates reserve outflows of about $2.13 billion over the next 12 months. These projections include outflows related to the restructuring terms agreed with the international sovereign bondholders in December 2024. In addition, the central bank estimates a short position of $3.9 billion in foreign currency forwards and future against the domestic currency. According to the report, a major portion of these positions is expected to be rolled over. Sri Lanka's banking sector reported stronger profitability in 2025, with after-tax profits rising 19.3% year-on-year to reach 369 billion rupees, according to data released by the Central Bank of Sri Lanka. The increase was driven by high interest income and sharp rise in non-interest income, even as operating expenses continued to grow. Profits before tax increased 3.7% to 583.7 billion rupees, while net interest income rose 11.7% to 1.02 trillion rupees. Non-interest income grew nearly 50% to 275 billion rupees. Operating expenses across the sector rose 10.3% to 493.4 billion, but impairments for loans and other losses declined significantly to 59.4 billion rupees. The sector's total assets expand 12.4% to 24.9 trillion rupees. Net loans and receivables grew 23% to 12.9 trillion rupees, while investments rose 3.1% to 9.4 trillion rupees. Meanwhile, deposits strengthened 11%, reaching nearly 20 trillion rupees by year-end. Profitability indicators remained broadly stable. Return on equity increased slightly to 16.7%, while return on assets dipped marginally to 2.5%. Total impairment coverage fell to 7.3% from 8.5% the previous year. Banks maintained a conservative lending stance with a credit-to-deposit ratio of 69.9%. In other words, bank lent about 70 rupees for every 100 rupees of deposits, keeping a substantial portion of funds in liquid assets and investments. The net credit-to-funding ratio stood at 154.1%, reflecting a cautious but liquid banking system with the capacity to expand lending if economic conditions strengthen. The Asian Development Bank has announced its commitment to provide more than $1 billion annually to Sri Lanka from 2026 through 2029. According to the report, the financing will focus on macroeconomic stability, private sector-led growth, education and skills development, and resilient infrastructure. Key initiatives include a major digital transformation program aimed at boosting Sri Lanka's digital economy. The support will also facilitate the country's integration into regional trade and investment networks through the Regional Comprehensive Economic Partnership. The announcement followed a meeting between ADB President and Sri Lankan Prime Minister at the bank's Manila headquarters. Both leaders reaffirmed the strong development partnership and highlighted their commitment to post-cyclone recovery, inclusive growth, and advancing women's equality. The ADB indicated that emergency financing is being fast-tracked to restore infrastructure and support livelihoods affected by Cyclone Ditwa. In addition, the leaders highlighted women's empowerment as a key pillar of inclusive development. The bank noted its ongoing partnership through the Women Entrepreneurs Finance Initiative, which expands access to finance, business skills, training, and policy reforms for women-owned enterprises. Sri Lanka became one of the first countries to adopt the Women Entrepreneur Finance Code nationally in March 2025. The Prime Minister also engaged in discussion facilitated by the ADB to advance Sri Lanka's skill agenda. This included initiatives to align technical and vocational education with regional standards, particularly with ASEAN countries and the Philippines. Sri Lanka faces renewed economic risk as global oil prices rise sharply amid the escalating conflict in the Middle East. According to a leading research firm, disruptions to global energy supply routes could significantly increase fuel import costs for Sri Lanka. The firm notes that potential disruptions to shipping through the Strait of Hormuz could push petroleum prices higher. This could directly affect Sri Lanka by increasing fuel import bills and driving up domestic inflation. Higher fuel costs are likely to translate into increased transport fares, electricity tariffs, and broader production costs across the economy. The government has also indicated the possibility of increases in fuel and cooking gas prices, as the conflict threatens supply routes for crude oil and liquefied petroleum gas. Sri Lanka remains heavily dependent on imported energy, making the economy particularly vulnerable to sudden spikes in global oil prices. The research firm also highlights potential risks to tourism, which is a key source of foreign exchange for the country. Airlines have begun rerouting flights to avoid conflict zones in the Middle East. This has increased travel times and pushed up air ticket prices. High travel costs and growing global security concerns could weaken tourist arrivals and slow the recovery in visitor inflows. Recent developments have also brought Sri Lanka closer to the unfolding geopolitical tensions. An Iranian naval vessel was sunk off Sri Lanka's southern water near Galle during US-led strikes earlier in the month. Survivors were later rescued by the Sri Lanka Navy. In a separate development, another Iranian vessel arrived in Colombo carrying more than 200 crew members, including cadets and senior officers. According to the research firm, these incidents have placed Sri Lanka on the edge of the conflict, creating humanitarian and diplomatic sensitivities while authorities manage rescue and port operations. The firm notes that the situation highlights the vulnerability of smaller energy importing economies to geopolitical shocks, especially when disruptions occur along major global energy routes such as the Strait of Hormuz. A sustained increase in oil prices could complicate Sri Lanka's economic recovery by raising import costs, increasing inflationary pressure, and potentially weakening external sector earnings if tourism slows. Sri Lanka's plantation companies are stepping up investments in renewable energy as part of a broader transition towards net zero emissions. According to the Planters Association of Ceylon, regional plantation companies have collectively committed more than 5 billion rupees for clean energy projects across the sector. The industry has also installed over 30 megawatt of renewable energy capacity across estates. These include solar, mini hydro, biomass, biogas, and waste heat recovery systems. The association notes that this shift represents a major transformation for the plantation industry, which is undergoing one of the most significant changes in its 172-year history. The move toward low-carbon operations has become increasingly important as global buyers, financiers, and regulators demand more sustainable supply chains. Energy transformation has emerged as the most advanced component of the sector's decarbonization strategy. Several regional plantation companies have developed renewable energy projects to power tea factories and estate operations. Companies such as Talavakkala Tea Estate PLC and Agarapatana Plantation PLC have invested in mini hydropower projects that generate electricity using estate water resources, providing stable energy for factory operations. Some factories across the sector now operate entirely on renewable electricity. Biomass continues to play a key role in meeting the sector's thermal energy requirements. Plantation groups including Brown's Plantation PLC and Agalavatta Plantation PLC reported that biomass boilers now meet between 85% and 95% of factory heat needs, reducing reliance on furnace oil. Solar rooftop installations are also expanding across tea factories, estate offices and worker housing. The plantation companies are also strengthening their emissions monitoring frameworks as part of their climate-aligned production strategies. Several regional plantation companies now measure Scope 1 and Scope 2 emissions, while some have begun assessing Scope 3 emissions linked to logistics and value chain. Sri Lanka's private sector borrowing from the banking sector slowed sharply in January 2026, reaching the lowest level in 11 months. According to data released by the Central Bank of Sri Lanka, total new private sector borrowing from the banking sector amounted to 82.6 billion rupees in January. New borrowings from domestic commercial banks stood at 108 billion rupees during the month, marking a 9-month low. The decline reflects weaker demand for credit or a more cautious lending approach by banks following a strong expansion recorded towards the end of 2025. Private sector borrowing had peaked at 263 billion rupees in November 2025. This later declined to 183 billion rupees in December and further to 108 billion rupees in January. Despite the slowdown in new lending, the total outstanding private sector debt stock continued to expand. By the end of January, outstanding private sector debt rose 26.3% year-on-year to reach 10.3 trillion rupees. Borrowings from domestic banks increased 29% year-on-year to 9.74 trillion rupees, indicating that Sri Lankan businesses continue to rely heavily on local banking sector funding. In contrast, outstanding debt from the overseas banking units declined 6.6% year-on-year to 556 billion rupees, reflecting limited availability of foreign credit lines. Meanwhile, net credit to the government declined slightly by 0.6% year-on-year to 8.3 trillion rupees. Exposure of the Central Bank of Sri Lanka increased 5.3% to 1.8 trillion rupees, while government borrowings from domestic banks declined 2.6% to 6.4 trillion rupees. Bank lending to public corporations also contracted significantly. Outstanding debt from domestic banks to public corporations fell 29% year-on-year to 422.7 billion rupees. According to the report, this reflects continued adjustments in bank credit exposure to state-owned enterprises. The latest credit data also shows a gap between lending intentions and actual disbursements. Although a recent credit supply survey indicated improving willingness among banks to lend across retail, corporate and small and medium enterprise segments, realized lending slowed at the start of 2026. Overall, while credit conditions appear to be improving within the banking system, the January data suggests that the credit demand or loan disbursements remained subdued during the early part of the year. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 7.61%, the 182-day T-bill rate stands at 7.91%, and the 1-year T-bill rate stands at 8.23%, down by 1 basis point compared to the previous week. Thank you for watching. We'll be back next week.